Hi everyone, welcome back. I'm Kirill Talai, investment analyst with a decade of experience. Here we connect the dots between macro, crypto, and AI. No noise, just what actually matters for your portfolio. Two stories today that I want to discuss with you. Fast. Let's talk about our July trade. It looks like the Nasdaq does not want to go higher. The near-term lag looks done for now. The market is fragile, and I think it's time to step aside and watch how it develops. Second, that is partially due to all the negative AI news that hit this week. Meta, the token price index, OpenAI, delaying the IPO. I want to walk through each one because when you actually look at them, almost none of them broke anything. What broke was the positioning. Quick disclaimer. Nothing on this channel is financial advice. I'm sharing my views and analysis, but you always do your own research.
This video was created in collaboration with the IT company Anderson.
Let me start with the market update. The last few episodes, I have said the backdrop stays good for risk assets. That big hawkishness was behind us, and the AI trade could keep working into July. And to be straight with you, so far, it's not really playing out smoothly. We thought the Nasdaq would keep marching higher. So Monday this week, it was fine. But Tuesday, it gave it all back. And now it looks like it is breaking down from support. So let me tell you what I'm seeing and what I'm doing about it. The first thing that does not look healthy is implied correlation. So the breadth of the market is damaged. This is the chart of implied correlation at the index level. Without getting too technical, it is the average correlation between stocks that the options market is pricing for the next month. And right now, it is extremely low. It is at 3.99, the lowest level since July 2024. And that matters because very low correlation tells you the index is being held up by a handful of names all moving on their own, while everything underneath is going in different directions. It is a sign the market is narrow and complacent at the same time. We already had one episode of this low correlation unwinding back in early June, and it led to a very sharp sell-off in the Nasdaq, 5% in a single day. And the last time it was this low was right before the August 2024 sell-off, which coincided with a massive intervention by the Japanese Ministry of Finance. So this is a real risk. The situation is not getting healthier. Anything, the concentration is getting worse. And the reason the breadth is not good is that everyone is piled into one trade, semiconductors. Let me give you the clearest example from this week. Samsung reported preliminary results this week, and they were extraordinary. Operating profit was up about 19 times year over year. Not 19%, 19 times. Revenue more than doubled. It was a record quarter driven entirely by memory, by the same DRAM and high bandwidth memory boom that has been powering this whole trade. And the stock fell almost 7% on the day. Just think about that. Profit up 19-fold and the market sells it. That tells you everything you need to know about positioning. Everyone is already in. The good news is priced. And when the news is this good and the stock still cannot go up, there is no one left to buy. We're seeing the same thing across the memory names and across the popular semiconductor names in general. And you can see it in the factor data too. Momentum, the factor that has been leading this entire market, has been bleeding. Momentum is basically a bet that stocks that are going up should continue going up. On this chart, this is the drawdown on the momentum factor, and it has been a violent move, down around 22% from its high. This is the crowded leadership unwinding. So here is what I'm doing. I think it is time to step aside on the hottest spot of this trade. Not to short it, not to call it up, Just step aside, monitor it, and watch how it develops from the sidelines. I think there will be better entry points, most likely in late summer, September, maybe October. The hardest trades need to rest and catch their breath. And that is what is happening right now. And this is not a change of view. If you go back a couple of episodes, the second half outlook I laid out still holds. In that outlook, I said we would get some bumpiness throughout the summer, that the market would need a pause before the next leg. This is exactly that moment. Nothing here breaks the bigger picture. The AI trade comes back, but right now, the leadership is exhausted, and the smart thing to just let it cool. The other side of that is rotation. When the money leaves the hottest names, it does not leave the market, it moves. And we should start to see it rotate into the sectors that have been left behind. In July, I would expect that to pick up, and we're already seeing the first signs of it. Look at the equal weight market relative to the semis and relative to the S&P. For most of the year, it was no contest, and the semis ran away with it, up around 68% since the end of January, while the equal weight index did about 9. But recently, that has started to turn. The equal weight market has been grading higher, while the semis cool off their highs. That is what early rotation looks like. And where does it go? Into the sectors that were not favored in the first half. I think it is time for healthcare, for example. Insurance has already broken out. Financials are doing all right. In general, quality names, the ones with healthy balance sheets that pay dividends, the boring compounders, in other words. Those should pick up some of the money that is carefully rotating out of semiconductors. And there is one more piece. This may also be the start of a bet on a weaker dollar. If the dollar rolls over, and we have been saying that it should and that it has peaked, that is good for miners and metals and mining in general, for materials, for industrials. So those are the areas I would be watching as this rotation plays out. Then today we got another round of escalation with iron, unfortunately. Let's see how it plays out, but I think it should fade quickly. The strategic petroleum reserve is almost depleted, and the US cannot continue the blockade of the Strait of Hormuz. And frankly, we got used to these headlines and just also very tired of them. One particular note before I move on. I actually posted this call on X on Monday, right as the Nasdaq was putting in its high. And that is the point I want to make. The video comes out once a week. I record it on Wednesday, it publishes on Saturday, and a lot can happen in between. So if you want the timely updates, the moment I see something like the Nasdaq topping, the place to get it is X. Follow me there. The account is linked below, and that is where the real-time calls go. Now, the second story. This week, there was a wave of negative AI news, and I want to go through it with you because I think most of it was badly misread. Here's the frame to hold onto. The news itself was not really that negative. It got perceived as negative, partly because a lot of people do not understand the underlying trends, and partly because the market is extremely fragile right now, as we just discussed. When positioning is this stretched and this leveraged, you don't need a bad news to get a sell-off. You just need a headline that looks bad on the surface, and it is enough to trigger an unwind of all that leverage. So the news did not cause this, in my opinion. The positioning we described earlier did. The headlines were just the spark, basically. Let me show you what I mean, one story at a time. Start with Meta. Meta announced that it's going to rent out its excess compute, the spare capacity it has. And the market immediately took it as negative. The logic went like this. If Meta has excess compute, it means they overbuilt. If they overbuilt, they spend too much on CapEx. And now they're going to cut it. And if the hyperscalers cut capex, then everyone downstream, the memory stocks, the chip makers, all the beneficiaries of that spending are going to struggle. The tide has turned. That was the read. I doubt that it is what is actually going on. This is a company that signed enormous cloud and compute deals earlier this year, in April and May, and on its first quarter call said clearly that it was still compute constrained, that what it had was not enough, and that it needed to scale up. And now, a few weeks later, we're supposed to believe they suddenly have too much. That just does not add up. Whatever you think of Meta and how they navigated its AI build-out, and there has been a lot of controversy, it is very hard to imagine management whipsawing like that. So, what is the better explanation? I think we have simply reached the point where renting out that compute actually delivers a strong return. Look at what SpaceX did right before its IPO. It signed a compute deal with Google worth around $920 million a month, and a separate one with Anthropic. That is real recurring revenue, and it helped the story going into the listing. Meta stock, by the way, has been awful. It is a worst performing hyperscaler, maybe slightly better than Oracle. So I read this announcement as management showing investors that all these compute can actually make money, and good money, the way SpaceX just demonstrated. We'll see what they say at the second quarter earnings, but remember, in the first quarter, they told us capacity was not enough. This is not a company winding down. It is a company that found a new revenue line. Now, everyone was talking about the token price index. There is a lot of misunderstanding on the market about how to read this one. It is the Silicon Data Token Expenditure Index. And the way most people read it is simple. The index is going down, so people must be spending less on tokens. So demand for AI must be falling. So the providers must be cutting prices because nobody wants it. That is the panic. But look at what the index actually is. Now, it is a usage-weighted average price of the tokens being used. It is a price index. It has nothing to do with volume. So when it falls, it does not mean the volume of tokens is falling. And let me give you 2 reasons it can drop that have nothing to do with weakening demand. First, the mix. Chinese open weight models are far cheaper than the US closed models. We talked about this in previous episodes. These models have been catching up rather fast. The GLM 5.2 model is now very close to the frontier models from Anthropic and OpenAI on capability, and it is at a fraction of the price. So people use them more and more because they're cheap and good enough. And when more of the total tokens are generated by cheaper models, the weighted average price naturally falls. That is, the index dropping while usage is actually rising, not falling. Second, price. The cost of tokens is coming down rapidly across the board because of efficiency, competition, optimization. The labs cut their prices for all sorts of reasons, and almost none of them are demand is collapsing. So a falling average price can just be the whole industry getting cheaper, which is exactly what you would expect in a technology that is scaling fast. So this index tells you very little about volume or demand. You cannot look at it and conclude AI demand is rolling over. Nothing about it says that. To actually track demand, you need a better gauge. And the best one I know of is the rental price for GPUs. Here's the actual compute market. Rental prices for GPUs are rising. This chart is the B200, NVIDIA's latest Blackwell chip, the best you can get. and the rental rate is going up, not down. Even after Meta's excess compute announcement, it kept climbing. The latest mark is $5.77 an hour to rent a B200. And look at availability. It is almost non-existent again. The B200 30-day average availability is essentially zero. If you want one, you cannot get one. So think about what that means. If the newest, most important chip is completely sold out and the price to rent it is still rising, how can anyone tell me that demand for compute is declining? It is not possible. At best, token growth is flat, and if it is flat, it is only because there are not enough chips to run more. The demand is there. The constraint is supply. That is the opposite of the scare. Two more, and quickly. There is a fear that because the Chinese models are so efficient now and so capable, the frontier models will not get used, and all the capex the hyperscalers are pouring in is basically wasted. Well, I think that is far too early to call. A frontier model is the frontier by definition. It is the best. The highest value work goes to it. And that is where the economic value sits. The cheaper, still capable models will generate the most tokens, the most volume. So you get most of the volume on the cheap models and most of the value on the frontier. Saying the capex is useless does not make sense today. We need to see how it plays out. This is my view. And the last one, rumors that OpenAI is holding off on its IPO. Some people read that as a warning sign. Maybe they have nothing to show, maybe revenue is not where they wanted, maybe they did not like how SpaceX traded after its listing. There are a lot of open questions there, and I don't think it necessarily means anything negative, but it definitely added to the mood last week. And that is really the point of this whole story. Put it all together, none of these headlines actually broke the AI story. The demand is intact, the chips are sold out, the compute is getting rented at rising prices. What you had instead was a pile of negative sentiment landing on top of extremely fragile, extremely leveraged positioning. That was just the bad cocktail. The news did not do the damage the leverage did, and that is why I think once this unwind runs its course, the AI trade comes back. Before I wrap up, the scoreboard. There is a big change this week. Everything tied to the chip makers and the memory names is coming out. Micron, Intel, the power semis, NVIDIA, and ASML. We are banking those calls and stepping aside. We're selling as discussed today, hopefully temporarily. In their place, we add the sectors where we think the capital rotates next: healthcare, materials, European financials, and broad European equities. I do not think we will keep these positions for long, most likely until the end of summer, letting the AI trade cool down. So you can see everything on the screen. So let me pull it together. The near-term lag of the AI trade is cracking. Implied correlation is almost at a historic low. Breadth is poor. Momentum is unwinding hard. And when a 19-fold profit at Samsung gets sold, you know the good news is fully priced. So I'm stepping aside on the hottest names, watching for better entries late in the year, and following the rotation into the parts of the market that were left behind: healthcare, insurance, financials, quality. And on the AI scare stories, Meta, the token index, when you actually look at them, none of them broke the underlying story. The chips are sold out, rental prices are rising, demand is intact. What cracked was the positioning, not the trade. And that is why I think the AI trade comes back. For the timely calls in between these videos, follow me on X. It is linked below. And that's it for today, guys. If you got something out of it, hit subscribe and like, and I see you next week.